What if you could double your portfolio in just 6 months? These 5 proven strategies can help you unlock incredible results fast. In this video, we'll reveal 5 game-changing moves to grow your portfolio quickly and sustainably. Stick around for tips that have helped investors see real results. You don't want to miss this. Number 5. The S&P Index Fund. First things first, you have to invest in an S&P Index Fund. S&P 500 is a tool to measure the performance of the biggest companies based in the United States as per the market capitalization. The index fund helps investors like you and me to get exposure about the stocks that make up the S&P 500 index. Now, investing in a stock fund is a lot more risky than investing in a bank or bonds, but it's still less risky than investing in individual stocks because that would mean your entire investment will rely on the success or failure of those specific companies. The S&P 500 works really well with returns. The average is about 10% annually over periods. Did you know that the S&P 500 Index Fund showed a 9.8% annual rate of return from 1928 to 2020? And of course, returns in one year tend to be different than the average. The difference could be higher or lower. Like the S&P 500, it returned 252% in the 2010s. That's more than even tripling. But that's the thing about investment, isn't it? S&P 500 can work really well for you, and the best part is, you don't even need a lot of expertise to buy an S&P 500 index fund. This is your sign to step into the game of S&P 500 index fund. Yes, the volatility comes with the investment. For example, during the pandemic, we saw a deep plunge in the S&P 500, but then we saw 100% returns from 2019 to 2021. That's not a guarantee for future results, but it's definitely a vision to spark your investment decisions. Number 4. Learn the rule of 72. This one trick can help you greatly if you want to double your portfolio. The rule of 72 has been a key player in the investment market for years, and the phenomenon is pretty simple. Divide 72 by whatever the expected annual rate of return is. By doing this, you can figure out how long it is going to take for your investment to double. However, the main purpose of this trick is to help you estimate the amount of time it will take your portfolio to double. Let's say you need that to happen within 6 months. But that would mean that your expected annual rate of return has to be at least 144, which is very rare. But this can at least give you guidance on how to plan your investments because you can just divide 72 by the expected return and know which of your investments will double faster. Number 3. Enter the real estate market. This one is known for being a slow process to double your portfolio, but if you do it right, you will see how quickly you can double your portfolio with just one estate investment. Because, with time, people are relying more and more on mortgages to buy a property. You as an investor can have an advantage. Let's say you have invested in a property worth $300,000 with a down payment rate of 20%. This means your upfront payment will only be $60,000. Now, let's say the value of the property has increased. It is now valued at $360,000. Now, the difference between what you owed previously, which was $240,000, and the new price, which is $360,000, is $120,000. So, you have invested only $60,000 of your own, and you got double the amount you had paid. This might not be the case for every investment, but it's a quick description of how easily you can double your portfolio with real estate investments. Number 2. Invest in a 401k account. Some of you may have heard about this one, but never gave it a second thought. But this is so much more than just a retirement account. If I had to choose a tool which was the easiest and with the lowest risk, it would definitely be a 401k account. For those who don't know about it, a 401k plan is a retirement savings tool that can help you as an employee to contribute a portion of your earnings to a retirement plan. Surely you will question how this differs from a traditional retirement plan. Well, the funds in your 401k are invested in different assets like stocks, bonds, and other funds, and the earnings from those investments contribute to your portfolio. Although this may be for long-term retirement savings, as an investment tool, you can use your 401k account to grow your portfolio. Once you set up your account, you can easily adjust your contributions as per your needs and allocate the funds however you want. This tool is offered by an employer which lets you contribute your salary. So, each employer's plan can differ in many ways. As for the types of investment options available for you or loan policies, you have to look at some things beforehand. And about your contribution, that can differ according to your plans for your retirement. If you feel like you need help with setting up, never hesitate to talk to a finance professional. Some people take it too easy, but getting professional help can get your finances to a level you may never have thought about. Number 1. Always follow the market. The stock market is very volatile, so it goes without saying that you have to follow the market and stay up to date. With corporate earnings and other factors constantly looming over the market, stock prices tend to change a lot. So recognizing and learning to adapt to these trends is a must if you want to strengthen your portfolio. Now, let's talk about how exactly you can recognize the said market trends. So first and foremost, you have to keep an eye on the reports from previous years. Take the data, analyze it, keep it with you, and make sure to go through it before making any investing decisions. You can look at the trend analysis and follow new outlets like Bloomberg and MarketWatch to be alert about emerging trends, and you can also keep an eye on the quarterly and annual reports of major companies. Now that we are done with that, let's see how you can respond to these changing market trends. First and foremost, never put all your eggs in one basket. So, if the trends change, you will have at least another option. Investing all of your capital in just one asset or company will always put you at risk. So once you diversify your portfolio, not only will you be safe when the volatility hits, but you can also easily get double the returns than just investing in one asset or company. In all honesty, doubling your portfolio by just 6 months is definitely possible, but it comes with a high degree of risk that no one wants to take. We have seen such quick growth in crypto markets and early-stage tech stocks, so you can put your cards in, but you have to be prepared. Because, as they say, fast money is not often built to last. This was our guideline to double your portfolio. Are you ready to change your financial game? Don't forget to hit that subscribe button and ring the bell because our videos can help you build wealth. Stay in the loop and do not miss out on any of our videos. Subscribe now. See you in the next video.